Right now, gold and silver feel quiet. No headlines screaming new highs, no viral panic, no explosive daily candles. Just silence. And that silence is exactly why this moment matters. Because historically, the most powerful moves don't begin in chaos. They begin in boredom. What we're witnessing right now is not the end of the bull market. It's the final accumulation phase before the next major leg higher. There are 5 signals all pointing to the same conclusion. Let's start with the chart. The technical structure is already built. Silver printed its all-time high at 121.79 on January 29th. The very next day, it collapsed. Down to $74 on massive volume, 317,000 contracts. That was panic, tourists, late buyers, emotional capital, maximum volume, maximum fear. That was the left shoulder. Then came the real test. February 6th, silver plunged intraday to $63.90. And then something extraordinary happened. It reversed $13 in a single session. It closed at $76.90. That wasn't speculation. That was a physical bid. That was the floor. Volume that day, 105,000 contracts. 1/3 of the panic peak. That was the head. Then, February 12th. Price dipped again, 74.37. Higher low, volume, 91,000 contracts. Not only lower than the crash, but lower than the head. That's the right shoulder. And today, silver sits around 78.30. Volume, roughly 28,000 contracts, 9% of the panic peak. Read that again. 317,000 to 28,000. Every selling attempt used less force and achieved worse results. That's not regrouping, that's exhaustion. The levels that matter support is clear. 74.37, the right shoulder low. As long as that holds on a closing basis, the structure is intact. The neckline? Between 84 and 88. A clean break above that range activates the measured move. Head at 63.90 to neckline near 84. Add that distance to the breakout. You're talking a new price regime. Triple digits are not a fantasy, they're math. Signal 1, COMEX, just rang the bell. Now let's talk fundamentals. The CEO of COMEX, Ken Lewis, just announced something important. Shipping times are back to normal. Backlogs cleared, customer service stabilized. The forums reacted immediately. Demand is dead. Wrong. That 8-week delay environment was retail panic. $15 premiums, tourist money flooding in, professionals cannot accumulate in chaos. They wait for normalization. Now the shelves are stocked, premiums are sane, and volume collapsed from 317,000 contracts to 28,000. That's not weakness. That's ownership transfer. Tourists out, professionals in. Signal 2, the February 18th snapback. 2 consecutive down days, sentiment turning. Then suddenly, silver rallies 460 in a single session. Gold surges $136 and closes back above 5,000. That wasn't gradual. That wasn't retail dip buying. That was stored energy releasing all at once. The physical bid reasserted itself. And look at what the institutions are saying. Goldman Sachs raised its 2026 forecast to 5,400, but added the phrase significant upside risk. That's code. It means the internal number is higher. JP Morgan, base case 6,300. Upside scenario 8,000 to 8,500. And this is happening while price is consolidating. That's not bearish divergence. That's preparation. Signal 3, the double contrarian. Let's go back to 2022, September 20th. The Wall Street Journal declared gold had lost its safe haven status. Price at the time, I'm 600. Gold then rallied over 200%. Now, negative coverage again. Bank of America calling gold and silver bubbly at 5,330. On the same day, JP Morgan publishes a 6,300 base case. Banks don't operate in chaos. If one arm is bullish while another calls it a bubble, understand the incentives. Short books need covering. Narratives help facilitate that. This is not analysis, it's positioning. And here's the pattern. At bottoms, media is loud and negative. At tops, media is euphoric. Right now, the tone is skepticism. That's fuel. The volume story says everything. Volume tells you who is active at the peak. 317,000 contracts. Today, 28,000. 9% of panic intensity. Professionals buy when it's quiet. They don't chase volume spikes. They absorb weakness. And when the neckline breaks, volume expands, not before. This is the quiet phase. The loading phase, the compression before expansion. In part 2, we'll cover Tether's massive gold position, COMEX inventory collapse, the 800 million ounce silver deficit, central bank allocation math, Bitcoin losing purchasing power to gold, and why this time is structurally different. Because 5 signals are converging, and they all say the same thing. The loading window is closing. So the structure is built. The inverse head and shoulders is complete. Volume is collapsing. Tourists are gone. Now let's talk about the forces underneath the surface, because the chart is only one piece. The real story is supply, allocation, and institutional positioning, and this is where things get serious. Signal 4, Tether, that's S, quiet declaration. Let S start with something almost no one is talking about. Tether, the largest stablecoin issuer in the world, now holds 148 tons of gold. That's roughly 4.76 million ounces. At current prices, that's around $24 billion. That makes Tether's gold position larger than the sovereign reserves of Australia, South Africa, and Saudi Arabia combined. Think about that. An entity whose mandate is to be a dollar proxy is converting dollars into physical gold. That's not marketing. That's a structural statement about fiat risk. When the dollar surrogate starts stacking gold, pay attention. COMEX silver, the inventory reality. Now let's move to silver. Registered COMEX silver inventory is around 82 million ounces. That's 75% lower than 2020 levels. In just 4 December trading days, 47 million ounces, 57% of total registered inventory were claimed for delivery, more than half, in 4 days. That's not theoretical shortage talk. That's documented flow. And zoom out further. Since 2021, the cumulative silver deficit is approximately 800 million ounces. That's roughly 1 full year of global mine production missing from the system. Industrial buffers that used to cover 3 to 4 months of demand are now closer to 1 month. That's tight, very tight. And remember February 6th. Silver dropped to $63.90 and reversed $13 intraday. That wasn't coincidence. That was the physical floor. When price touches true scarcity, it snaps back. Signal 5, the central bank shift. Now let's look at gold from a global perspective. After Russia's reserves were frozen in February 2022, every emerging market central bank learned a lesson. Dollar reserves are not sovereign. They can be frozen, they can be weaponized. And since then, 4 consecutive years of central banks buying over 1,000 tons of gold annually. That's unprecedented. A recent survey shows 95% of central banks expect global gold holdings to increase. 43% plan to add to their own reserves. That's not speculation, that's policy. And here's the kicker. Average global portfolio allocation to gold is below 1%. JP Morgan ran the math. If allocation simply normalizes by 0.5%, well, that was the argument. But now look at the dollar. On the monthly chart, the dollar index broke below 100. An 18-year ascending trend just broke. That's structural. The dollar is losing not just to gold, but to other flawed currencies. And in a race to the bottom, capital doesn't choose the least bad currency. It chooses assets constrained by physics. Gold, silver, finite supply, no printing press, 5 signals, 1 direction. Let's recap. The inverse head and shoulders is complete. Retail normalization opened the door for professionals. Media negativity is historically contrarian. Physical supply is structurally tight. Central banks are reallocating. All 5 signals converge. They don't conflict, they align. And when structure and fundamentals point the same direction, the quiet phase doesn't last long. Tactical summary support, 74.37. Hold that level. Structure intact. Neckline, 84 to 88. Break that range. Trigger activated. Volume, 28,000 contracts. 9% of panic peak, that's exhaustion. Physical floor, 63.90, proven on February 6th. What this means for you. Physical holders, hold. The thesis is data-backed, not price-dependent. Paper holders, understand delivery risk relative to COMEX inventory. New buyers, dealers are stocked. Premiums are normalized. That window does not stay open forever. When the neckline breaks, volume returns. Premiums expand, availability tightens, and today's entry becomes yesterday's opportunity. Final verdict. 5 signals, 1 structure, 0 ambiguity. This is not distribution, it's accumulation. Silver at 78 is not a sell signal, it's a loading price. The professionals are buying on 28,000 contracts while the tourists are gone. The transfer of ownership is complete, the loading phase is ending. And when the neckline breaks, the quiet will be over. Stack now.